So in this lesson, we're going to talk about what is CRT, what is candle range theory, what is the why does it occur, what is it used for? Is it used for your higher time frame, your lower time frame, your entry, your bias? What are the pros and cons? What is the good and bad? And our ETM modifications, where after we explain the entire theory, we'll add a few things, subtract a few things to make the trade more optimal. So let's talk about the candle range theory. So as you can see, you have a bullish candle, and understand you'll be working within this candle. The range will be formed in this candle by marking up your low and your high. And what does this candle represent on the lower time frames? This is simply a swing low and swing high. So the low of the candle here is your swing low, and the top of your candle is your swing high. So now as you are waiting for your next candle, the next candle starts off bullish, but quickly flips and turns bearish, forming a wick. And now the candle starts off bearish and still closes bearish. So what are you anticipating for the next candle? Your next candle should fill out the range. So it should completely take over the range and absorb the liquidity underneath that swing low. So what would be your trigger? Your trigger would be this current candle's low. This will be a trigger. Once price gets below this level, you can anticipate price to reach for the second liquidity, which is at the bottom of the range, fully completing the candle's range. Candle starts off bullish, flips, gives you that wick, and closes bearish beneath your swing low. How this formation would look on the lower time frames. As you can see, you have your bullish candle. Your bullish candle on the lower time frames will have consecutive swings. So this would be the bottom of your candle, and now this would be the top of your candle. So now starting off the next candle, the candle starts off bullish, takes out the previous candle, but quickly comes back inside of the range, forming your change of character on the lower time frames. Now price comes back into the micro range and closes bearish. So what are we targeting now? We are targeting that candle low. And as you can see, that candle low is the bottom of your break of structure on the micro. So what are you waiting for the next candle? You're waiting for the next candle to break below the previous candle. Next candle starts off bullish, forms your wick. Before you proceed, please make sure you like the video and leave a comment. This helps us a lot since this video is completely unmonetized. So another variation is multiple candles inside of the range, but the concept still remains the same. Liquidity will be grabbed and price will fill out the range. So let's talk about the high volume continuation entry. So once price breaks below the candle low, you're instantly in a trade. So it's basically a breakout trade, and your target is the bottom of your range. So once price breaks below this level, you're instantly targeting this range, and your entry is upon the breakout. The basic functions of a candle. Candle has four functions. It will be a candle open, a candle low, a candle close, and a candle high. So as you can see, this is how this candle would translate on the lower time frame. So you would have your candle open. Either you will get an accumulation, or price would instantly go for your manipulation, which in this case would be your candle low. And now you have your distribution, which is heading towards making your candle high. You can see here, and a pullback for your candle close. And a good example would be here. You can see this is your candle open. Right here you have your candle open. Candle high is made via manipulation, and price distributes, makes your candle low, and a slight pullback for a candle close. So to start off our lower time frame expectations, let's start off with our instant internal rejection. And what we're going to focus on here is our third candle. This lower time frame formation is going to form within this third candle. So what makes this instant internal rejection different is that once this candle opens, it instantly targets a internal rejection, internal liquidity. So in this case, price is going to instantly target this extreme supply. So once the candle opens, price instantly targets that extreme supply and rejects and covers the entire candle's range. So let's talk about instant internal rejection. So what do we have here? We have a bullish candle that's trapped in a bearish candle's range. And what happened? Liquidity's been taken. So price took out the liquidity. Price took out the liquidity and closed back inside of this candle's range. So now let's target this candle's range is high. This would be the candle range is high. So now we have our candle range. So where would our trigger point be? Our trigger point would be in the current candle's high. So this would be our trigger point. So now what do? We go on the 1 hour time frame. And when trading the instant internal rejection, what are we waiting for? We're waiting for the candle to start off instantly targeting an internal level. And what do we have here? We have a bullish order block. Let's mark up our bullish order block. And what can we anticipate? This next candle to open instantly bearish, target the internal liquidity, and flip the candle as the candle opens right here. You have a candle flip right here and instantly targeting this level, therefore targeting this level as well and closing out the entire range. So in case you're still confused, let's go over this one more time. So what do you have here? You have your bullish candle. This is your high and this is your low. And what's following is a bearish candle. So what happened after this bearish candle closed? You conducted that price took out the high, took out the liquidity that was resting above the previous candle and closed back inside of this candle. So this would be your candle close. So now when looking at it from a CRT standpoint, you're targeting your candle's range. So the bottom of the candle will be your candle's range. So now what you're looking for is for the next candle to close out this range. By close out, I mean for the next candle to complete this range. So now let's look at it from a micro standpoint and specifically looking at instant internal rejection. So the next candle starts off bullish. So now this candle is bullish. And what happens next? Price targets a previous level. So if you look right here, you would find a internal liquidity level right here. So here you'll have an internal liquidity level somewhere like this. Price will reject from this internal liquidity level and drop down. So what you would have at this point is you would have price opening, but once price gets back to the candle open, this bullish momentum turns into a wick. So let's say price started off bullish, but then quickly turned bearish. So when that happens, a wick is formed. Now you have a wick. And this is the point where we're at right now. Once price got back to the low, price is currently a wick from a macro standpoint. So where would your target be? Your target is this low right here. So once price gets below this low right here, you're targeting the entire range. Now price gets below this level and closes out the entire range. And this is how you get your macro bearish candle, closing out the entire range. So what was the important thing? The important thing was as price opened, price was in a rush to grab sell orders at an internal level of liquidity. So let's talk about the instant external sweep. So price's main objective is to grab external liquidity before attacking your trigger point, therefore closing the range. So as you can see here, price grabs liquidity via sweep. And how it would look on your macro is price will start off bullish, but quickly the candle will flip and that bullish movement will end up as a wick. So now when price approaches your trigger point, the next level is closing out your range. So that will be your target. So let's talk about the instant external sweep. So what do we have here? We have our bearish candle trapped inside of our bullish candle, and we have our bias, which we'll cover in a second. An extremely important topic that a lot of gurus leave out. So you have your liquidity sweep here. This is where the liquidity was swept, and this is the bottom of the range. So actually, let's color code it. And let's mark our trigger point. Now, you don't have a lot of range to work with, and we'll cover that in a little bit. But this is the range that we have to work with from here to here. Now, let's go on the 1 hour time frame. So what is our instant external sweep? So the goal here is for price to quickly grab liquidity. You have a swing high right here. Price grabbing liquidity real quick and instantly targeting your level. And once price gets below this level, you can confirm this level as well. So let's mark our liquidity. As you can see, once the new daily candle opened, price instantly grabbed the liquidity. And now what is our target? Our target is right here. This will be our trigger point, and the end of the range will be right here. So in case you're confused, let's cover this one more time. So right now we're going to draw out this candle. We're going to draw out this previous day candle. Obviously, we're anticipating the trade within the next candle. So this candle starts off bullish. Price quickly drops, makes the low, and closes right here. So now that you're anticipating your next candle, price can take out either previous day's level of liquidity, or price can take out current day liquidity. So let's say the new candle that starts off right here, candle forms a swing and gets below it. So price can now either target this level of liquidity or the previous day's swing level of liquidity. A lot of times there's only one present. So the good thing is you only have to target one level of liquidity. Let's say now price takes out current day level of liquidity and drops back inside the range, gets below your trigger point right here. Price gets below your trigger point, you're in your trade, and your target is to cover the entire range. What about context? This is something a lot of gurus fail to mention when teaching the CRT. And if you're actually serious about trading this strategy in the live market and not just marking up hindsight charts, I would suggest you apply it. So as you can see here, you have your bullish trend. So now you have a bearish candle that quickly turns into a bullish candle. And now you have your candle range. So you have your candle low and your candle high. So now you have your range set. So a lot of traders will anticipate a lot of bullish momentum. Why? Because based off the past two swings, the trend is bullish. The order flow is bullish. So now you get a bullish candle that quickly comes back inside of the range. Then that bullish momentum turns into a wick and the candle closes bearish. So even though you got a bearish candle, still a lot of traders will anticipate bullish momentum based off the previous two swings. So now what happens? The next candle starts off bullish, inducing traders into taking buy positions, going long. Then the candle quickly flips and closes bearish. And why did that occur? If you look to the left, you'll see an extreme supply level. And that level will stop price from continuing the bullish trend and quickly turning bearish. So let's talk about another variation. You see you have your bullish trend. And now you have a bearish candle that flips and turns bullish. And now you have your range. So you have your range low and your range high. So as you can see here, even if you look to the left, you can see that price broke structure. So not only you were bullish on your recent swings, which is your previous two swings, you are bearish on the macro as well, on the complete overview, because price broke the previous peak. So now your next candle starts off bullish, but quickly comes back inside of the range and closes bearish. What would your next candle be? You can see the candle starts off bullish, quickly flips, and closes bearish. And why did that happen? Because as this whole formation was occurring, price took out major liquidity and closed back inside of the range with the second candle. So the third candle was a high probability candle to the downside. So let's talk about context. So as you can see here, if you ask a lot of retail traders, they would anticipate this next candle to be bullish. They would anticipate this next candle to be bullish. Why? Because they would think that this is a character change and now this is a start of a bullish trend. Not only that, they would think that this is a rally, drop, rally. Something similar to, let's say this, where you have a drop, rally, drop. Here you have a drop, rally, drop. Here you have here we actually had a reversal. Here you have a rally, drop, rally. So they would anticipate a formation like this. But why are we anticipating CRT? Because as you can see, this bearish candle is trapped within this bullish candle. Price took out liquidity and came back inside the range and closed and gave you enough range to work with. So you have this entire range to close out. What's another clue? Another clue is that this candle took out major liquidity. And not only that it took out major swing liquidity, price came back inside of macro range as well. So you look at this swing high right here, this swing low, this is the macro range. So not only that price came back and closed back inside of this candle's range, price took out major liquidity and came back inside of the macro range. So this is the high of the range. This is the low of the range. And now let's look at our trigger point. So this would be our trigger point. So now let's go on the 1 hour. So what are the possibilities here? Obviously, you have your range right here and you can instantly target the extreme. So this would be the extreme of this range. And you can use the entire swing for a more of a macro range. So now have a extreme level right here. So now you have your two options. You can take a short right here, or you can take a short right here, or you can wait for price to reject from one of these two levels and come back to your trigger point and take an entry at your trigger point. Once price breaks below this level, so let's take a look at this example. So here you have your range, you have your CRT candle high, and you have your candle low, and this is where the liquidity was taken, and here is your trigger point. So what would stop a lot of traders for even looking at price from a bearish standpoint? Well, if you look at it right here, price took out liquidity. So even smart money traders are getting destroyed here. So price took out liquidity, and this would be considered a return to origin. This would be your RTO. And not only that, you can look at it from a subordinate resistance standpoint. Price is rejecting in this level. The zone right here is rejecting price. The price is rejecting from the zone. So a lot of traders will be bullish here and will completely ignore what's going on here. But why are we bearish? Not only that we have our CRT formation, but that's not the only reason. One, if you look to the left, you'll see a bearish order block here and price is rejecting from this level. So this is one reason. Now, if you want to add even more context, and this one is the actual more important, look at this right here. Price is rejecting from this swing here. And again, you're wondering what's the context behind this specific swing? You can look at it from this standpoint. Price broke structure, came back, and retraced. So you have a rejection. Not only that, if you look at it from a lower time frame standpoint, let's say we go to the 2-hour, you can see that price is rejecting of structure. So price tried to reject of this level once, twice, and broke structure. So you can see that price is finding rejection this level. So, or as a lot of traders, they wouldn't be looking at this situation as a bearish scenario, but as you've seen via context, that we have a bearish order block pushing this entire motion down. Not only that, you have your immediate context right here. So these are the reasons for you to be looking for the next candle to be bearish. See, once price got below this level, it instantly dropped. So this is the ETM modified model double scoop. As you can see, price starts off bearish and instantly attacks your trigger point. So you would anticipate price to continue to the downside. And if you look to the left, you would see that price is bearish and you would anticipate price to fully close out the range. But no, price has other ideas and price instantly turns around bullish and that bearish momentum is gone. So now what happens next? Now price revisits that area again and fully closes the range. And that bullish momentum turns into a wick. So in case you're confused, let's go over this one more time. Obviously, this is your previous day, and now we're anticipating our next day with our candle open right here. So what happens? Remember, first, let's mark up our trigger point, which would be right here. So price starts off by taking your trigger point out, and instead of continuing to the bottom of the range, price comes back for a second. Price come back and looks for either external liquidity or internal liquidity. So let's say in this case, price grabs external liquidity and then comes back to your trigger point for the second time. And once price comes back to your trigger point for the second time, you can anticipate a smooth ride back to close out the range. So now let's look at this example one more time, but now let's use our double scoop entry model. So this would be the bottom of your range. First, let's mark up our trigger point. So this will be our trigger point. It will be the bottom of the range. And this will be the top of the range. Now let's go on to 1 hour. So what are you expecting when using this entry model? You're expecting price to reach your trigger point, but instead of continuing to the downside and closing out the range, you expect price to come back and look for internal liquidity before visiting the trigger point again and continuing to the downside to close out the range. So here, your price reaching your trigger point, but instead of continuing to the downside, price came back looking for internal liquidity. So obviously you can mark up the extreme of your range right here and expect a rejection right here. Or if you're not comfortable, you can always go on a lower time frame and look for a order block. So use the order block right here. And now that price reach your trigger point again, you're targeting the low of your range. So if you're really serious about trading and ready to take the next step, make sure you join our Discord community, where we cover a new lesson every single week and a new entry model every single month. So let's talk about targets. And a lot of gurus who teach this strategy always leave this out. And what you need to understand as a trader, you get paid on your exits, not your entries. So Here you have your CRT, and here you have your trigger point. So again, your target is the bottom of the range to close out the range. But what is the high probable exit? What is the highest probability exit? Now let's go into 1 hour. Let's color our trigger point. So yes, understandable that the target is to close out the entire range. But as far as probability goes, your highest probability exit would be the 50% from your trigger point all the way down the bottom of the range. Mark up the 50%. And this would be your highest probability target. So this could always be your first target that you reach, and you take partials and before you go break even and target your second. So let's say you enter the trade right here. Price reaches the 50% here. You take off 50% of your trade and move your stop loss to break even. And now you're targeting a risk-free all the way to the bottom of the range. And let's look at this example. And this happens pretty frequently. Price grabs internal liquidity. And now it's your target point, and now price reached the 50%. So thicker. This is the 50%. Look what happens next. Price reached the 50%, came back, closed the day outside of your range, and now the next day is when price filled out your entire range. And sometimes price reacts off your 50% and instantly changes direction. So this is what I mean by the 50% here is the high probability exit point. Now again, price could reach your target down the line, or price could take you out and you look for another entry or whatever it may be, but the highest probability is the 50%. Let's look at another example of your targets. So here you have your trigger point. Here you have the top of the range. And here you have the bottom of the range. Now let's go on the 1 hour. So again, what is our first target? Swing low, swing high, and this is the 50% between your target and the bottom of your range. Now this is your DP. The smaller. Now let's take a look. As you can see, once price reached the 50%, price reversed. So this is your first danger point. And any danger point is a point where you take profit. And the reason we look at targets this way is because of the probability. So your first target should always be your fair price, because this is where price is even. Now, once price gets to your discount, this is where price could also be bought at. So these are all your levels of danger. And your third target would be your external liquidity, which is at the bottom of your CRT range. As you can see, a lot of times price finds it easy